Today, we will talk about guaranteed investment contracts, GIC, which are commonly used in retirement plans as a low-risk investment option. A guaranteed investment contract is a contract between an insurance company and an investor, typically a pension fund or an employer-sponsored retirement plan, such as a 401k. The investor agrees to deposit a sum of money with the insurer for a specified period of time, and the insurer promises to pay the investor an agreed-upon interest rate, as well as to return its principal. Employees who participate in a 401k or similar plan often have GICs as one of their investment choices. GICs are sometimes called funding agreements. A GIC works something like a certificate of deposit from a bank, although GICs are typically purchased by institutions rather than individuals and often come in much higher denominations. Like CDs, GICs are considered a relatively low-risk investment. They also provide a lower rate of return than many other investments. In retirement plans, GICs typically appeal to risk-averse investors or those who want to balance out their portfolios by putting some of their money into a low-risk account. GICs are often offered to retirement plan participants as part of a stable value fund or similarly named conservative investment option. Most GICs have either a fixed interest rate or a variable interest rate that adjusts periodically based on a particular index. The word guaranteed in the term guaranteed investment contract can be misleading. While the insurance company guarantees that it will pay the agreed-upon interest rate and return the investor's principal, that guarantee is only as solid as the insurer itself. GIC investors also face interest rate risk, as low interest rates can be easily outstripped by inflation, leading to a loss in purchasing power. The U.S. Office of the Comptroller of the Currency defines a synthetic guaranteed investment contract as a diversified portfolio of fixed-income securities that are insulated from interest rate volatility by contracts, wraps, from banks and insurance companies. In this arrangement, the 401k plan and its participants own the underlying invested assets, the portfolio of fixed-income securities that supports the stable value fund. With a regular GIC, by contrast, the insurance company owns the underlying assets as part of its. No, there is no federal insurance for guaranteed investment contracts, unlike certificates of deposit, many of which are covered by either the Federal Deposit Insurance Corporation, FDIC, or the National Credit Union Administration, NCUA. Here are 4 key takeaways. 1. A guaranteed investment contract, GIC, is an agreement between an investor and an insurance company, typically used in retirement plans. 2. The insurer guarantees the investor a certain rate of return in exchange for holding the deposit for a specified period. 3. GICs typically appeal to investors who are either risk-averse or looking for a conservative investment to balance out the more volatile portion of their portfolio. 4. GICs pay a relatively low rate of interest, putting them at risk of inflation. Hope this would help. Thanks for watching.